Good afternoon, everyone, and welcome to the latest in our series of professional advisors working lunches. Today's lunch is brought to you courtesy of Dynamic Planner. I'm Andrew O'Kelly with Professional Advisor, and I'll be your host for today. The impact of sustainability on an investment's risk and its suitability for a portfolio is now front and centre for governments, regulators, managers, advisors, and clients. Well, to discuss why savers should be thinking more clearly about overall portfolio sustainability risk and how advisors can use the available tools to measure and consistently assess the issues and drivers of sustainability to help people fund their better futures, we're joined today by Abhimanyu Chatterjee, Chief Investment Strategist at Dynamic Planner, and taking the practitioner's point of view, we welcome back Unique Financial Planner's Managing Director, Philip Martin. Now, before we start today's session, I'm just going to briefly run through the obligatory housekeeping notes. Your microphones and cameras are currently turned off. Please do keep them that way. It'll ensure that there's no background noise so speakers can be heard more clearly. There will be time for a Q&A session at the end of this presentation, so do please feel free to ask any questions for Abby and Philip using the chat function, which you'll find probably at the bottom of your screen. I will endeavour to put all of your questions to our speakers at the end of the session. I should also inform you that today's session is being recorded and that we'll send you a link to the recording by tomorrow, and do please feel free to share that with your colleagues. As usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you your proof of attendance along with the link of the recording of this session. So here are today's learning objectives. To understand the importance of risk in ensuring suitability. A reminder of the regulatory responsibilities around risk and suitability. To understand the new regulatory responsibilities around sustainability and suitability. And finally, how to ascertain a client's sustainability preferences and use this to inform fund choices. So that gets the housekeeping out of the way, and let's move on to our main event. Let me hand you over now to Dynamic Planner's Chief Investment Strategist, Abhimanyu Chatterjee. Afternoon, Abhi.
Thank you, Andrew. Welcome to this forum, and thanks for taking the time to listen to me. I've just named it from the Queen's song because I love Queen as a band, and moreover, it's something that is becoming more and more apparent in our scope of work. We want it all, and we want it right now. So, what a year it has been. As I sit at my desk in my little office in my home, thinking about it all, the markets have been haywire. That we have had the shortest bear market in history in financial markets, and frankly speaking, the financial markets has resembled a yo-yo going up and going down. It was then followed by a sustained bull run powered by tech companies. In case you hadn't noticed, that Amazon has the same market cap as the whole DAX index and climbing. On the other side, as happens during these periods of time, the regulators have been very active. They have been trying to figure out how to protect everybody and investors even more. And as a result, we have been faced with a slew of regulations and questions and letters which have been coming out. I must say, I am in awe of you guys, all the financial planners who are here today and across UK, that in a year like this, you have done such a tremendous job. And every time we speak to one of my clients a Dynamic Planner, I am really in awe of you people as to how you manage to help your clients reach their end goals and objectives. And having said all this, let's take a step back. We need to talk about risk. It has many definitions. We speak about risk in many ways, either loss or illiquidity, or a lot of concepts which are quite difficult to deal with and understand. But having said that, there are many definitions, but the outcome is the same. The biggest risk that we have is A, not being able to identify the goal of our client properly, or B, not being able to meet the goal of the client. So these are the biggest risks that we have today in whatever we do. Come to think about it, risk assessment and mitigation has been ingrained in our DNA. That's how we survived till now and will continue to survive in forward. But for some strange reason, whenever we talk about investments and things like that, we always talk about returns. It's always how much we gained. And especially, it fascinates us if we come across or hear somebody speak about how much they gained on their portfolio or investment in the shorter term, like a year or 6 months. Or so whenever we read in the papers, oh, Bitcoin has gone up X amount over the last 3 months, we are fixated on that number. We forget that the number of Bitcoin halved in value in a matter of a week or so, and then ran back up. So if we were invested in that, maybe we would have made a lot of money, but there would be a time that we would be really, really struggling. So the question has to be driven by risk. The regulator increasingly is trying to focus our thoughts on the risk rather than the returns. And all the regulation that has come out and has been and is speaking about is focusing on aspects or variants of this risk. At this point of time, I would like to ask Philip a quick question. Philip, how do you handle these questions around risk within your practice?
Well, good afternoon, Abhi. Good afternoon, everyone. Well, obviously, risk is a complex subject. I mean, it has had a tendency, I guess, over the past 20 years or so to be restricted merely to questions about what clients feel about volatility in portfolios. So we're very much trying to widen that definition of what risk actually means in terms of the potential outcomes for clients. So risk isn't just the volatility from point to point. It's, is there enough money for you to live the way that you want to live in the future? Do you need to be taking more risk in order to achieve what you want to achieve? What is the risk of you falling short in your savings objectives? So as part of our overall process, both in terms of giving initial advice and ongoing servicing of clients, we're very focused on a far broader definition of what risk actually means in terms of outcomes.
Thanks, Philip. And that's exactly the outcome that I wanted to talk about. That risk suitability is a much wider thing. We have to ensure you as an advisor have a number of problems in assessing risk suitability. To ensure that the risk of the investor is assessed and assessed properly. Then the next step comes that once you have worked your time with your client, you have found out the risk capability, found out his capacity for loss, then you have to look at the target market. Nowadays, it is said the target market, which phase of his life the investor sits in, and what product can be suitably used by him or recommended to him. So then you have to ensure that the risk of the product is suitable for the investor appetite, as well as suiting the target market. Finally, you have to ensure that the product remains suitable for the investor on an ongoing basis. So it's just like Philip said, it's just not a VAR number or a volatility number or a loss number. It's a much, much wider thing that you as an investor, as an IFA or a financial advisor has to take care of. On top of that, there is the regulatory aspect. So we all know, all of us are very, very much aware of the regulatory aspect. There's the RDR which started, then there's PROD, then there are applicable COBS rules. But personally, I think none of you as a financial advisor do the things that you do because the regulator tells you so. It's you, most of you do it because it's best practice. That if you could properly assess the client's needs and goals and risk, then you could properly find a suitable investment for him. Then you could do the whole process end to end, which gives you a sense of pride as well as helps the client meet his objectives. So at Dynamic Planner, we think about this in great detail as to how we can help you. So not only are we looking at the rules and building our products in such a way that it helps you go through the regulatory landscape, tick all the boxes, but it also helps you to do your job in the best possible manner. We have all been aware of this investor life cycle, that the wealth of an investor starts from a young age if you start investing properly, which I didn't, and I'm still doing managing running around right now. But your wealth increases up to a certain amount of time, and then in retirement you take a drawdown. So we think, a dynamic planner, we think and we research everything and try to build the software as well as the products that go along with it to meet all the different stages of investing. So what we call the product life stages. In the beginning of an investor's life, we feel that a client should not be looking at the portfolio that he has. As a financial investor for 20 years and having run portfolios with hedge funds and asset managers, the worst thing I always felt and was ingrained in me is to look at the value of your portfolio. Literally, if you watch it every day, the rise of your value going up and down across with markets going, it creates a lot of stress. It creates a lot of, and could quite possibly lead to decision making, which could hinder progress and lead to wrong outcomes. So we felt that at an expansion stage, a suitable investment product should be able to maximize return for a given risk level, the risk level being determined by what the client needs to achieve his goals, which is using a risk questionnaire, a capacity for loss questionnaire, which you guys already have. Then the product should also have the flexibility so that the fund manager, having seen a tactical chance or tactical allocation which can enhance returns or risk-adjusted returns, should be allowed to take it. So, for example, if the fund manager saw that tech was going to pick up post-COVID, when COVID was going on, he would be allowed to take on a slightly more risk and enhance the profits that you could get. These are solutions, what we call risk profiled, a dynamic planner, what we call risk profile solutions. So the idea is these products remain within a risk band for the majority of their lives, but sometimes the fund manager, based on his calls, either increase or decrease risk to go out of the risk bands to give you the best possible outcome. Well, that's fine. But when we get to the stage in the curve, you remember, where your wealth is reaching its peak, it is not desirable that the fund manager goes up and down the risk scale to enhance returns. What you need to do is that this is the case where the risk, excuse me, the risk of your loss is the most because the wealth is maximum. So therein, the fund manager should stick to a risk band and just move within the risk band so that there is no adverse outcome which has not been planned for. So these are the ones which we call risk target managed solutions. So there are fund managers who are contracted to stick within the risk bands of dynamic planner. And finally, in a stage where there is drawdown. So in that case, not only is a fund manager, does your investor as a client need to reduce the vagaries of losses of the markets by smoothing the returns, he also has to be able to maintain capital. It doesn't matter that he provides you an income and the capital value of your portfolio goes up and down all over the place. So he has to be able to maintain capital while mitigating downside loss so that you have a smoother journey and your capital lasts for longer. So at Dynamic Planner, we have designed products which are called risk managed accumulation products. They are marked by these different badges. If you look in the market, you will find some of them who come to us and get this badged. And we feel, and our research has shown that this kind of segregation helps you with your target market, helps you and helps the client, more importantly, to achieve their objectives and meet their goals. So how do we ensure this? If you remember, we said the third point of risk suitability was ongoing suitability, that as a financial advisor, you need to be sure that the product you suggested was not only suitable on the first day, but all the days in between and to the time when you review it. So what have we done at Dynamic Planner which helps you solve this problem? So we have created a set of benchmark allocations which maximizes returns for a given risk level. Again, the risk level being determined by 10 cohorts of clients that we have created from our different, from the time we have been building risk questionnaires. And for each solution, for each target volatility range, we have manufacturers like the fund groups who create either risk profile, risk target, and risk decumulation solutions. Majority of the solutions as of now has been created in risk profiled. There are fewer risk target products and even lesser risk managed decumulation product. So what do we do at Dynamic Planner? When we give a solution a badge, not only we do a deep review of the products in the sense that we look at every holding that they have, determine all the risks that come associated with it, including credit risk, liquidity risk, and market risk, and then give it a badge. But not only that, every quarter we review the funds that have come up for badging, and again using the underlying holdings, and keep on ensuring that they remain within this risk bucket. In a way, we keep on top of the funds, and we have dedicated analysts following the funds who know each and every step the fund manager makes, and every time there is I won't call it an anomaly, if they're stepping outside the box, the fund managers also know that they're going to get a call from an analyst trying to understand what is going on with the solution, and does affect the long-term profile that we have assigned the solution. In effect, we are acting like your in-house investment risk team to ensure that your suitability is ongoing, or suitability process is ongoing, and it's less stressful for you. At this point of time, again, I would like to call on Philip to ask him, how does he address this question of ongoing suitability with the products vis-a-vis his clients' preferences and risk attitudes?
Well, I guess there's two facets to that, Abby. I mean, one is just ensuring that the original recommendation remains valid throughout its duration, and so we could either do that by accessing a single fund solution, which is doing that internally within a fund by means of rebalancing back to asset allocations that match the client's requirements, or indeed within a portfolio that's doing exactly the same. So mechanistically, it's more straightforward to do that through the use of platforms, either through rebalancing or single fund solutions. I guess the other part to this is really the ongoing assessment of suitability and risk, which we see as an integral part of the ongoing review process. So that should be picking up. Is the plan on track? Are we now behind schedule? Do savings need to pick up in order to plug the gap? Does more risk need to be taken with part of the portfolio in order to plug a gap? So these sorts of conversations are now becoming routine as part of the ongoing engagement that our advisors are having with clients. So I would say there's two parts to that, really.
Thanks, Philip. That's absolutely spot on. That these sort of questions should be had every time you meet or you even think about your clients. But I'm aware that you have number of clients, and keeping a track of all these number of clients can be time consuming and a vast amount of work. At Dynamic Planner, we are trying to solve these problems by taking away or reducing the need for focusing on certain bits of the solution, wherein I have spent my life as an investment risk manager with very large risk houses. I spend my time managing portfolios, and so we speak to fund managers and try and ensure that that part of the work is taken care of for you. Now, let's move on a little bit. So this is the World Economic Forum's question. Every year, World Economic Forum asks all its people who attended, what do they think is the perception about the top global risk going forward? And if you see, this goes on from, I think, from 2008 onward, they have been conducting this questionnaire. And earlier, it always used to be financial risks used to dominate, which is the ones in the blue boxes. They used to dominate loss of markets melting down, or asset bubbles, or inflation, or this, that. And there were always economic ones used to dominate the perception of risk. You see that 2020 was the first year where there was no economic, all the risks are green. That means the questions around biodiversity loss and ESG and sustainability were at the top of our minds. And 2021, you can see that there is other risk involved. So the financial aspects have completely disappeared. So everybody's risk is now focused in a different place. Reacting to this, the EU government came up with SFDR, which is information about ESG characteristics and products. And the most important regulation, which I think, having looked at ESG products and sustainability, all this for some time, and trying to write articles on it, that trying to find a common vocabulary as to definition as to what is environmentally sustainable and what this whole thing encompasses. What are we looking to try and achieve and do? So this is a many people have said that this is a knee-jerk reaction, but I think it's a very timely and proper conversation, a grown-up conversation about ESG, in the sense that instead of getting all emotional about it, we are first trying to determine what is it that we are trying to talk about. It's very important. So the amendments come up. The regulations, I've tried to compress these regulations, which are pages and pages of very dull reading, trying to compress them in these 3 points. That ESG considerations have to be taken into account in every investment and advisory processes. The second bit is that all asset managers have to integrate sustainability risks into their risk management process. That is easier said than done. And it's a project that I am working on with a few other of my colleagues across the industry. And believe me, there's, if you put, and we are all quants, right? We're trying to put a number on the risk. And if you put 6 quants in a room, there are 13 outcomes which can be possible. So we are all discussing on these problems. The third point is all advisory firms have to consider the preference of sustainable products as part of their clients' needs, characteristics, and objectives. So ESG preference, but the most important bit is that ESG preferences should only be addressed after suitability has been addressed. So it is quite interesting that while the whole world is talking about ESG and this, that, and the other, we are always saying ESG is a bolt-on to suitability and not the be-all and end-all of it. And that is very important, because when we do an assessment on, when you look, for example, when you look at a company as financial advisor, when you look at a stock, you are in your head, you're automatically doing an ESG type analysis anyway. When you look at Tesla, if you think about it, oh, Tesla went up so much. Elon Musk shot off his mouth. As a result, the stock price went up. So, excuse me, in a way, you are doing the G component, which is the governance component, automatically in your brain. And we're ingrained to do this. But having a regulation means once suitability is taken care of, only then do we consider the ESG preferences. The asset management industry responded to it very quickly. So you see there are currently around 3,500 funds which have been launched till now, and new launches have been around 2,000 funds have been launched last year, and 2,000 and counting. We have been inundated, literally inundated by ESG funds trying to get risk profile badges or risk target badges from us. But there's also been the flip side to it, in the sense that a lot of managers have repurposed old funds by adding names to it, like sustainable or responsible and this and that and the other. As part of our work, and that makes it even more difficult for you as an advisor to sift through all these funds to figure out which one has been repurposed, which is a true ESG, under what conditions and what criterion. So we at Dynamic Planner have also tried to help in solving these problems. First of all, we asked, prior to all these ESG regulations coming out, and before ESG became the watchword, we asked our Dynamic Planner users that whether they discuss sustainable and ethical investment options with their clients during annual reviews. And this was the outcome which came out. And while we are here, we thought it a great idea to conduct this survey for the attendees. And I think we'll be seeing the survey come up right now. There we go. And could I request you to please vote in on your preferences? In the meanwhile, while you vote, could I ask Philip again a question? I'm sorry, Philip, I keep on asking you these things, but what is the response about ESG and sustainability from your clients? And how do you deal with them in your practice?
Well, there's no doubt that the wider coverage of this has begun to prompt conversations with clients which are much more proactive. It's clients asking rather than necessarily being something that's been prompted from us on the other side. But I think we've approached it in a slightly different way, rather than regarding this as in effect, a completely separate proposition that needs to be tackled and addressed and then decide whether it needs to be adopted. It's become much more integral into our standard investment offering anyway. So our core investment offering accesses an existing suite of funds which are managed by institutional relationships, and all of those institutional relationships have a pickup right at the outset that determines, is that fund manager a signatory of the UN PRI, for example, the Principles of Responsible Investment, and all of them are. So we've moved far more into an ESG embedded within the core proposition anyway, rather than as a singular alternative to a different form of investing. But so therefore it naturally forms part of that conversation.
Excellent. And Philip, I must say, you guys, you are one of the people who are out there at the cutting edge, literally. So we speak to people who have all ranges, literally. They want to create something which is non-ESG to something which is ESG, and something in between, and everything in between. So thank you for sharing, for voting, and surprisingly, it matches the results we found, and except that there is nobody disagrees or so it's getting better and better. That ESG is becoming, and sustainability is becoming a very important part of investing. So let's move on. The first thing we need to address is, what is the question that we're trying to address? Is it ESG or sustainability? We at Dynamic Planner have defined sustainability to be the overarching objective. It is not only the question of making profit while doing good, which is the sustainability criterion, but also to say that our investment will outlast us and go on, and could be possibly be handed over to the next generation and the generation after, and so on and so forth. We say that this is sustainability as a whole, that it lasts, it helps, and it is good for the environment and everything as well. And the measure of sustainability is the ESG criteria, the economic, the environment, social, and governance. So we also feel that ESG is a preference, like active or passive or model portfolios and collectives. And we all know how many conversations we have had amongst ourselves and with our peers. So we feel that this has to be a question which the client has to decide. Maybe he does not want a ESG or a sustainable product. Though going forward, I don't know whether he will find any product which is not sustainable oriented or ESG oriented, because it has to be part of all products being sold in Europe and UK very soon. So what we did was we leaned on our strength of creating questionnaires based on psychometric techniques. We have done that before very successfully when we built the risk questionnaire, and we have been using that, refining that in conjunction with the Henley Business School. and one of my supervisors, PhD supervisors, is part of us who works with us in creating that. And what we did was we took that model and created a questionnaire driven by the same psychometric techniques to the attitude of risk to create a questionnaire which encompasses the client's view and determines his response to the ESG models. So we have set out five of these buckets, let's put it. It's conventional, which is really not interested in ESG, to personal values, where it is the whole investing is driven by the personal values of sustainability. We have found that using the questionnaire and testing it, and we have found that the majority are interested in sustainable products because they think it is worth having investments which do good as well as grow. So what does it do? Like our attitude to risk questionnaire, this questionnaire helps you having a meaningful conversation about the clients and understand their motivating factors, which is a very good start point. And that always goes a long way in trying to build a product which suits the client's objectives. Then it provides a description of integrating ESG, environmental, positive things approach, and also and scores them accordingly to the risk questionnaire and grades them. Having done that, that's fine, all well and good. We have determined that the client is in the sustainable bucket and is looking for a product which is ESG conscious. But given that there are, as I showed you earlier, that there are 2,000 new launches plus 500 repurposed items, plus the existing 26,000 products that are there in the market today, how do you go about finding a suitable product to match your client's requirement? So we teamed up with MSCI, a dynamic planner. To solve this problem, we have teamed up with MSCI, who we have worked with in great detail to create the ESG fund metrics research reports. So these research reports look into each underlying holding, like we do, and assign a risk score based on approximately 100 odd criterion, and then they grade it up to give it a score from between AAA to BBB and everything in between. So this allows you to match the ESG characteristics of a product to the ESG requirements of your client. And at the same time, what we are doing in addition, and this will come on, the ESG reports are already on stream, and you can look it up in Dynamic Planner and you can find them for the OICs. We also plan to extend that for the model portfolios. And finally, we plan to extend that the ongoing suitability of these products, as we do for the risk. We plan to do the same for the portfolios going forward, and that should come on stream a bit later. So not only will you be able to capture the risk of your client, the suitability components, the risk components, you will be able to match them and monitor them on an ongoing basis, so that these numbers, these facets are all at your fingertips, and you will be able to use them in detail with the client. So finally, before I end, what we have tried to do is take away all those worries that you have as a financial advisor, and try to reduce them, try to simplify the process of risk, the process of estimating risk and understanding the risk, then matching risk suitability, and also matching the ESG risk suitability, and so on and so forth. Hopefully, trying to do all this, and I assume in a very accurate and proper way, will take away some of the worries that you have, so that you can concentrate on what is more important, your clients and your business. At this point, I will open up for questions. Thank you very much.
Thanks, Abhi, very much indeed, and also to Philip for that very insightful presentation. I just before we move on, let me just return to our learning objectives, and Abhi has underlined the importance of risk in ensuring suitability. He's provided a reminder of the regulatory responsibilities around risk and suitability, explained the new regulatory responsibilities around sustainability and suitability, and finally, Abhi's provided suggestions on how best to ascertain a client's sustainability preferences and use this to inform fund choices. Now, just before we get to our Q&A, just a wee bit of housekeeping, if I may. We have a couple of delegates online who we are unable to match with our registrations. What that means is that, unfortunately, unless we can find out who you are, we can't send you your CPD. Those two users or delegates are their icon. One says user, the other says Diana. If you look in the chat function, which you'll find at the bottom of your screen, if you look in the chat function, you'll find you've each got a message from Joe just asking if you could identify yourselves. If you would do that, please, we'd be very grateful, and we'll be able to send you your CPD certificates. Now, we do have 10 to 15 minutes available for Q&A, so please do participate by typing your questions, as I said, in the chat function, and I'll make sure that I ask those questions to Abhi and Philip. I'll kick off with a question from Alan, and actually it's a couple of questions I've put together. And I think I'm going to pose this to both of you, if I may, and I'll start with Philip. Alan asks, are risk and volatility confused in their use? And do we have a risk appetite and a volatility tolerance? Philip, I'll come to you first and then move to Abhi.
Well, yes, I would agree. I would maybe even suggest it's even broader than that. So in my remarks earlier on, I said I think we have concentrated far too much in equating risk to volatility in portfolios, and that is one element of risk, but it is by no means, well, A, the only risk, and B, in some cases, the most important risk, because when you sit down and do work with clients, in general, they will perceive their biggest risk as not having enough money to do what they want to do and what they plan to do, not how you get there, not the path to get there. So in general, I'd agree with those statements. I think we need to think far more broader about the risks of not achieving certain outcomes. And in some cases, it requires an even more grown-up conversation, which is your risk appetite may be one thing, but your risk reality relative to how much you have to save and how much you have may need to be something different, or your expectations need to be curbed accordingly. And that is where I think financial planners can add real value to the conversation with clients. So I agree, but I think the definitions of risk need to be even more broad than just risk appetite and volatility tolerance.
Absolutely. Abhi, what's your view?
I second everything Philip said, but I think the two questions are getting confused because we are in the financial markets, and risk is a very, very wide topic. Risk can mean any adverse situation is risk, right? So we are doing risk assessment every day. In financial markets, till date, volatility has been a measure of risk. Again, it's the same thing as sustainability is objective and the measure is ESG. In financial markets, risk is the objective and the measure is volatility. So we tend to confuse these two. But if we go away from that question, risk may be liquidity, that you invest in a property fund and you're not able to take your money out. That's a risk. Or like Philip said, not meeting your goals. So risk is a very broad aspect, and volatility is just one of the measures of by which you measure risk.
Sure. Following on, Alan is just saying, is it an ability to maximize return that a product gives, or an opportunity to maximize return? If there's a risk, then there's a chance that a loss will occur too.
So we can maximize return to. So risk and return are two sides of a coin. There is a relationship between risk and return. The more risk you take, the more return you get. To the extent where you go into something like investing in a startup, where there are binary outcomes and the payoffs in each case is massive. Either you lose everything or you get a massive payoff. So we are trying to balance the outcomes of risk and return. We cannot talk of one without the other. So when we were talking in financial markets and portfolio management, we always talk per unit risk. So if I take X amount of risk, what is the incremental Y output that we get? So that's how we define it. But that is really, it doesn't matter. In the end of the day, the risk is what the client has to take or needs to take in order to achieve his goals. And given the level of risk that he can, there is only certain amount of return you can get, because in market risk terms, we cannot measure all the kinds of risk, liquidity risk, the probability that your company blows up and all this. We can't do this. So in terms of market risk, when we say, we talk in terms of unit risk and try to maximize that instead of just maximizing risk return in the first place.
Okay, thanks, Abhi. I know Philip, I think, has got a question for you.
Yeah, I was interested in the way that you categorized some of the potential solutions into three parts of the life stage, in particular decumulation. So one question I guess everyone will be keen to know the answer to is, how are you managing potential sequencing risk, particularly in the light of market downturns, as we had right at the beginning of lockdown and the COVID crisis? How is that built into your modeling and the outcomes?
Right. That's a very interesting question. Thank you, Philip. First of all, we started with the premise that we saw that sequencing risk was an issue. It doesn't matter if you're not taking any drawdown. Wherever you start, whatever path you take, it doesn't matter because it matches up at the end. The moment you start taking drawdown, in the sense that you are selling down units of your product, sequencing risk becomes an issue. I honestly could go on for hours about this, but let me make it very short. If at the initial stage of when you're starting to take drawdown, if you have a massive risk, massive loss, that creates a bigger adverse condition than if you have it later on in your life. So what we did was to ensure that the products kind of minimize the lowest percentile of drawdown through their portfolio construction, month on month and month on month. So the product literally every month, it checks against the allocation. It checks the allocation and says, fine, this month in ex ante terms, we can think that will remain within the lowest loss amount that we expect it to happen. And this is how it builds it up month on month on month and carries on. So that creates a much smoother line, reduces the sequencing risk difference between products which don't do that, and it helps a lot. And these are what we call the risk managed accumulation products.
Okay. Now here's one it comes up a lot these days. How can advisors complete satisfactory ESG fund research without accepted industry standard analysis? You get an awful lot of questions like that.
So I know we also get a lot of questions every time with our clients. It is hard. It's very, very hard, because the taxonomy or the definitions are not quite set, which the EU SFDR regulations are trying to do. Let's say if we set the definition, then we have to rely on people who can collect the data of all the instruments that are there, or all the funds that are there, of everything that's being held in solutions, and aggregate them and by some way scale them. Hence, and it's an extremely hard exercise. For example, only on the carbon impact, you can cover around 15 or 16 different criterion. So you have to rely on someone to provide a data provider. Today, there are 2 or 3 major data providers, of which we, a dynamic planner, think MSCI are the best, because they have been working in the equity markets for ages, and then they have come up with a scheme of aggregating them. And in a way, if we don't have the wherewithal, like we do with the risk bit, that we outsource it in some way to an expert, we have to do that and outsource it to somebody who can gather the data and aggregate it. So in our case, we have tied up with MSCI and help you achieve that outcome.
Yes, thank you for that. It's an ongoing issue, isn't it?
It is a massive issue.
Yeah, yeah. And Philip, I think you've got another one here, haven't you?
Well, Andrew, I was about to say, I mean, it sort of feels that the industry needs to sort itself out on this issue now before the inevitable car crash from greenwashed, talked up, overhyped, rebadged product that starts to go wrong and ends up with a poor outcome in the hands of clients. You would like to see the professional industry fund bodies coming together and starting to get some acceptable definitions and acceptable practice before that happens. But there doesn't seem to be much sign of it thus far.
No, I think a number of the ratings agencies are still scratching their heads, aren't they, about what should and shouldn't be included in such research. I guess we'll get it eventually, but it would be very useful right now. Philip, have you got any other questions for Abby?
Yeah. I mean, I think I know my own view of this and my own answer to this, but I know it's a perennial question that's posed around any portfolio that has an extra selection criteria, either to take the universe down or to bring it up from a lower base. To what extent do you think adopting an ESG approach to fulfillment means either automatically taking on more risk or potentially accepting the potential for lower returns?
It's a very interesting question, Philip. In the past year, all ESG funds have performed admirably. If you do just a historic test, simply because they had all invested in tech companies, and tech has grown, right? I'm not disputing the fact that tech is going to be an integral part of our lives going forward, but for the ESG funds, they were heavy tech and underweight the industrials, the airlines, and all these companies, and their portfolios have performed. Our first question we had when we were talking about ESG and internally we spoke about is that, does it reduce the universe? Initially, yes, it did. But as more and more companies transition and sign up to the UN perspectives, transition into this green universe and make their presence felt and start issuing instruments which are dedicated to this, then the universe will increase, will broaden. So there's also one question, one area of a very gray area in this green world, which is how ESG are the government bonds. So if you look at all the criteria on which kind of reduce ESG and social governance and all that, governments can be, if they're subject to the same test, we would not be able to invest in government bonds. So there is a huge discussion to be had. There's a huge question to be asked. And I think we are the people, practitioners in this industry, who can really solve this problem, as saying that how do we want to approach this and where do we want to take it? So if at one point of time, say looking far into the future, if all the companies have signed up and to the Paris Agreement and what the principles are, then ESG will be just a footnote, right? We will not consider a fund as ESG anymore. It will be boiled into everything, like you are already doing. So we will not talk about this anymore. It will be something else, won't it? So it is a very interesting question, but we do find the universe opening up. We do find more issuance. Whether then the questions of that Andrew asked about greenwashing and all that comes up, but somehow I think we'll get there, but it'll take some time, some questions to be asked and answers given before we get it to the best possible scenario.
Okay, I've got no more questions at the moment from the audience, but I have one for you. and again, it gets asked an awful lot. Does building a very green portfolio automatically mean taking on more risk, or is there a safer way to do it?
Is there a safer way to do it? I'm sure a multi-asset portfolio, if you have a multi-asset portfolio, and you can build in criterion which selects funds which are either which first of all, as we said, that first we think about the risks in the portfolio as to what are the losses and the outcomes. As I keep asking everyone, that let's ask this fundamental question. A company says that, oh, I do not emit any carbon into the atmosphere, but in doing so, not doing that, I will default on this loan to the bank. The bank will not say, oh, fine. They will make the company go default. So that's the first risk we'll have to think about. So once we create all that, and then we put in all the criterion for filtering the funds, I'm sure we could possibly come up with a equivalent risk of the solution wherein the ESG preferences are being met. But there are also other views, in the sense that Moody's had come up with a comment that in the credit world, the ESG is a negative impact rather than a positive. So that means where you are, you can only go worse and not get any better. So that's Moody's opinion, and I'm just quoting it. But I think as more and more instruments come out and is available, then we can start talking about this in a much more suitable manner, and we can build equal, if not equal risk portfolio. We'll never go lower, but I think we can build equal risk portfolios with the ESG criterion.
Okay, Abhi, thank you for that very fulsome response. I'm afraid that is all we've got time for today. So thank you for your questions. And thank you, of course, to our two speakers for a really valuable session. But before we sign off, just let me remind you of some dates for your diary in the next month. Next Wednesday, we're back with Rafa again. Your portfolio is about to get punched, and why low risk must be most vulnerable. Matt Smith, their investment director, was going to review the lessons from Q1 and assess the future for bonds. At the end of the month, we've heard quite a bit about ESG today already, but we've got our ESG masterclass on the 28th and 29th of April. You'll be able to hear keynote presentations there from Next Wealth's Heather Hopkins, Peter Toogood from the Advisor Centre, and two experts from FE Fund Info, as well as 6 excellent presentations from Aberdeen Standard Capital, Bailey Gifford, Close Brothers, Goldman Sachs, Pictet, and Royal London. And into next month, on the 12th of May, we're back with Bailey Gifford, where their client service manager, Paul Roberts, will offer some insight on how to combat inflation and generate a sustainable income for life. So altogether, that's 7 tasty hours of CPD for you in the next month, and it will certainly fill you up with ESG. So that's it for today's session. All that remains for me is to thank our two speakers, Abhi from Dynamic Planner and Philip from Unique Financial Planning, for their excellent presentation. But let me reserve the bulk of our thanks to you, our readers, for your company this lunchtime. I trust you found this session helpful and worthwhile. And if you did, we'll look forward to seeing you again for next Wednesday's Professional Advisor Working Lunch. Goodbye.